All yours.
Thank you.
Oh yeah, we're at Coastal Town. Thank you so much. We're here at Coastal Town Realty. Thank you. And that's why I love that woman. And the next woman that I also love, Thomasina, this is she's the managing broker. So thank you for having us today. And she obviously is a great cook. She's the one that kind of chefed up what we had in there. And then obviously I have my wife here as well. She's also a mortgage banker with American Financial Network. So reach out to myself or her if you have any questions. I love that. It's like Arsenio Hall. Aged myself on that one. I'm going to step away. Yeah, we'll see you. Thank you. Ute, everybody.
It's all the time, doesn't it? I really appreciate being here and having you all come and hear about my favorite topic, at least outside of work or inside of work. Outside of work too, I talk about it all the time. So 1031 exchanges are a wonderful vehicle for people who own investment real estate or are trying to change where their property is located, change the type of property that they want to be invested in. It is a wonderful tool, and it comes from Section 1031. People call it Starker exchanges because the Starker family were the first ones to really utilize it in a new and improved way. It's called 1031 exchanges, tax-deferred exchanges. Unfortunately, some people call them tax-free exchanges, and that's not really true because it is just a deferral. But obviously, for people who are in investment real estate for the long haul, it is a great tool. So Section 1031 of the IRS code says that you can defer your capital gains taxes and your depreciation recapture taxes if you, quote unquote, exchange your investment property for other like-kind property. Oh, that's another name for it, like-kind exchanges. So the great thing is that all real estate, as long as it is held for investment, is deemed to be like-kind. So you're not limited to staying in the same type of property. Are we doing okay?
Yeah, the camera followed me then.
I was saying it.
Yeah, it likes you best.
I think it's the, okay, should be capturing you now. Should be good.
So it allows you to be in the kind of real estate that works best for you. I get a question all the time is, if I'm selling a condo, do I have to buy another condo? No. So you are able to buy the kind of investment real estate that works best for you. Now, when the section came along, it's historically, it's been around since the 1930s. And the way it came about was in the Midwest, farmers would sometimes swap parcels with each other, like somebody's son married somebody's daughter. And so they did something. And then the taxing authority came along and said, hey, you sold something, so you're going to owe taxes. And the people said, but all we got was other dirt, right? All we got was other real estate. And so that was the genesis of the section. But the likelihood that you have what I want and I have what you want, and we swap with each other, it happens on occasion. And then you can just do that and do a deed of exchange and don't need an intermediary if you do it at the same time. But the most likely scenario is that you're selling to one person and then buying something else from somebody else. So, and that's where historically, again, it was that idea of swapping properties with each other. And then in the 60s and 70s, this family, the Starkers, came along and they said they would sell some commercial property and then they'd take the money and wander around for a while and then they'd buy something else and they would amend their tax return and say, we did an exchange. And the IRS said, no, you didn't. And it went through the courts and they won. And that is where all the rules started to come in, because the IRS said, well, if people can just do that willy-nilly and, wait years, we'll never know whether we get to keep the tax revenue that we collected on this capital gains and this appreciation recapture. So we are going to make some rules. And the first rule was that you are going to have a qualified intermediary. That is the role that my company plays, Towne 1031 Exchange, subsidiary of Towne Bank. And you can't ever touch the money. So the role of the qualified intermediary is to document the exchange for you and to hold your funds beyond your constructive control. So, And then they came up with a bunch of rules with timeframes in order to stop people again from, saying, well, maybe I'll find something next year or whatever. So the timeframes all, the time rules all start on the day of closing.
What is it?
I'm telling you right next, I promise. Are you just so excited? So the most important thing is that the documentation to evidence the exchange has to be in place before you close. We now, in our RAIN contracts here in Hampton Roads, we have a 1031 language pre-printed, section 22, I think, is of the pre-printed form. There's language in there that allows people on either side to do a 1031, but that's not sufficient. So you have to have engaged your qualified intermediary before you close. We get the contract, we find out who's doing the closing. David and I work on together all the time. He sends me a contract right now, and we we find out who's handling the closing, and so we prepare the documents and send instructions to the settlement agent, because we want to see on the closing statement that there's no constructive receipt to the seller when they sell the property. So on the closing statement, rather than having the net proceeds go to the seller on the bottom line, you want to see them, we show them as a line item of 1031 proceeds to Towne 1031 or something to that effect. Because the IRS says, every agent I've ever heard speak says the first thing we look at is the closing statement. And if it shows money going to the seller, we presume they didn't do a proper exchange. Timeframes. Closing date sets the clocks running. 45 days to identify, up to 180 days to close. And I say up to 180 days to close because when you're doing an exchange towards the end of the year, what it really is the shorter of 180 days or the date your tax return, including extensions, is due. So if you're doing an exchange in December, the tax return due date April 15th comes faster than the 180th day. So if, for example, you're buying something that's still being built by a builder or something, and you need the full 180 days, you would need to file for an extension on your tax return to get the full 180 days. What we do at Towne 1031 is we send once the funds are received. So again, first we prepare the documents based on the contract. Then we reach out to the taxpayer to collect the information that we need to open a bank account for their benefit. And that is, we don't bundle the money into one big account. We have a separate account for each exchange. And so we have to collect the information. As I always say, banks are, still required to collect all of the detail in order to prove that it's really you and all of that. So after the closing happens, the funds get wired to us, or we get a certified cash or a cashier's check overnight, put in that account, and we then send a deadline letter and an ID form that you can use. And that's the last piece of the extra rules that the IRS put in as a result of those starkers, is that, so, you have to have it in place before you close. You have to not ever get the money. You have to have a qualified intermediary. And then you have to follow the identification rules. And it's a three-pronged set of rules. The first rule is called the three-property rule. And what it says is that if you limit yourself to identifying, or you can identify up to 3 potential replacement properties without regard to their value. So the idea behind the three-property rule is again based on the fact that there's these rules tied to everything, is that usually the idea behind it is that you pick a property and you give yourself a backup or 2. In this recent market, that hasn't been terribly, realistic, but that's the idea behind it, because there's 2 bad things about 1031s. The first one is that after midnight on day 45, you can't substitute something else. You're stuck with what you've identified by that point. And the property has to be identified so it can be located. So if it's a house, it's the address, or a building, it's the address. If it's a farm somewhere, it's, 75 acres, blah, blah, blah. Tax ID number, parcel ID numbers or something of that nature. But so the first bad thing is you can't substitute something else. The second, yes.
To identify that property doesn't mean that it has to be under contract.
So technically, no, but again, with keeping in mind that you're not going to be able to substitute something else down the road. Right now, with the way the market has been, most of my customers kind of come with both contracts in hand.
Ute, one
Yeah.
quick one. What was the question again? So everybody online, there was like 17 people online. What was the question one more time?
When she says identify the property, like you have to have a property identified, does that mean that it has to be under contract?
When you identify the property, do you have to be under contract? That's what the question they just asked. And that's what
Right,
Ute
and
is answering.
no, you
Sorry about
don't.
that.
Yeah,
Let me-
no, you don't. Technically, you don't have to be under contract, but again, when you realize that, is that still going to be there if you put it on that list? That's a matter of risk tolerance, I think, more than anything. So up to 3 properties, that's the rule that the people who want to just buy one property of equal or greater value to switch from this to that, that's the rule that they use. And that's that's the rule that works for them. The second rule is called the 200% rule. And what it says is that if you want to identify more than 3 potential replacement properties, then you have to list a fair market value next to each of them. And the aggregate fair market value, adding the 4, 5, 6, however many together, can't be more than 200% of the value of the property that you sold. So you realize that if you want to buy something of equal or greater value than what you sold, you're going to run out of 200% before you run out of 3 properties. So you stick with the 3 property rule. But it's for people who want to, diversify. So if you sell one big thing, 1031 is useful for a lot of reasons. So some people say, I have this, whatever this parcel, and I want to buy a bunch of different things. Relocate them or diversify your holdings. That's where the 200% rule comes in. It kind of says that, I call it you can't attach the Hampton Roads multi-listings and say, I'll buy a few of those. So you have to limit yourself a little bit. I'm sorry, there was a question. Land is good. Yeah. So what the question was, what qualifies? Does land qualify? Yes, any real estate that's held for investment is deemed to be like kind, and you're not limited to buying the same type of real estate again. Absolutely.
So you had like 3 residentials and then you decided to go with 1 commercial?
Commercial, you
or
could
vice
do that.
versa? Could
Yep.
you go 1 big
Sell a commercial and
then
buy
go-
a bunch of houses. Yep.
Are you locked into those 3? If you do the commercial, like say you identified the 3 properties, are you locked into those 3? Or
No,
can
I
you-
think in that case, you might, if you say, I'm selling something for a commercial parcel for $1 million, and I want to buy 5 houses, you're using the 200% rule. Yeah, yes.
If you sell a $500,000 property and you want to buy a $200,000 property, the proceeds from the $500,000 property, do they all have to go into the $200,000 purchase for the exchange, or
So,
can you get any money back, the difference that you want to hold back after 20% down or whatever?
yeah, so the question is, do all the proceeds have to go into the replacement property? And the answer is yes, and it's even more difficult than what you just alluded to, because if you're selling something for 500,000, and I'm gathering your net is going to be 200 because you're paying off a mortgage and you have some closing expenses, but if all you want to buy is a $200,000 property, you might not help yourself with an exchange, because to fully defer your capital gains taxes, you have to trade equal or up in value, which is the contract price. All the net proceeds have to go into the new property. And here's where I always say, which is why I'm not a CPA. Everything that you get that's not like kind property, namely not other real estate, investment real estate, is deemed to be taxable boot. That comes from pirate booty. that's the word of the day. And taxable boot can be, I get cash boot, right? You take some cash out to go on a trip or to remodel your kitchen, fine. The other kind of boot is mortgage relief boot. And I just had been dealing with a SEAL who's really hard to get a hold of. And he leaves questions at all odd hours. But he and his wife sold some property in California, very expensive. And he was trying to only, quote unquote, buy the net proceeds money. And so one way of having taxable boot is if you have mortgage relief boot, you pay off a mortgage on the old property and you don't replace that with either a mortgage or additional cash on the new property, you're going to have a tax consequence. And then it becomes a question of, are you still helping yourself with a 1031? Because the way your adjusted cost basis in the property that you're selling is protected is that travels forward into the new property. I get that question all the time where, why can't I take the money out that I already paid taxes on when I bought this, when I put it in the front, on the front end. So the concept is that, again, to fully defer your tax obligations, you have to trade equal or up in value. And if you're looking at your adjusted cost basis of your property that you're selling, that's what you paid for it, plus any capital improvements that you made, like a new roof or HVAC and stuff like that, less the depreciation you've taken. The difference between that number and your sales price is your gain. And if you're, quote unquote, only replacing your adjusted cost basis, you're not deferring any gain and you're not helping yourself with an exchange. So, yes.
I have a question.
Yeah.
So what if there was a property that sat on two pieces of land that were actually deeded separately?
Okay.
Could you still do a 1031?
But you own both of them? I mean,
Right. Well, technically a house sits on the two properties that are deeded separate.
yeah,
That's no
Yeah.
problem. Okay.
yeah. If you're the owner of the whole thing, that's perfectly fine. Just how you got it doesn't really matter.
Okay.
So
I just didn't know if
I'm
it was considered two pieces of.
Oh, no, no. If you're selling under one contract, I have the same question sometimes. I have a guy right now who's going to sell 5 houses to buy one beach house. and he has 5 contracts with the person who's buying the property because they're going to get separate loans, but he's selling them at the same time to the same person. So to me, that's one exchange. Yeah.
My question is similar to that. Let's say I have a 1031 exchange, 1.5 million. They're rolling that into 3-4 separate properties. We've established checking accounts for each one. And then you say 3 for each exchange. Can those 9 to 12 be kind of identified intermingled? Because it's the same transaction. The 1031's coming into, I've got property here, 3.
Oh, okay. So you're having separate exchanges. You're selling to different people at different times and you're doing.
No, I've
No.
got one one seller who's got the 1031 and they're buying 3 to 4 properties.
Okay.
So if it was a single, we would identify 3, right? So then that could be up to 9 to 12 properties. Can I have a property over here if I'm identifying 3? Like say Chesapeake, I've got 3 properties. Virginia Beach, I've got 3 properties. Likes.
I'm still not sure I follow because if you're selling,
Like 3 different 1031 exchanges for, is that what you're
are
saying?
they
Yeah.
selling 3 different, they're selling 3
they're selling
properties.
one big and they want to buy 3 or 4
Right.
smaller.
Okay. But then they can identify 3 or 4 smaller, not, well, maybe if they're freaking me out. If, as long as they stay under the 200%, they can identify as many as they want. So if they're selling for $1.5 million, they could, I guess, identify 14.5 $100,000 properties, right? Something to that effect.
Mhm.
But so I just want to finish with those rules because there's a third rule that I used to call impossible, but there's an optometrist in Portsmouth who proved me wrong. And what, what it says is that it's called the 95% rule, and it limits your ability to fudge around with the 200% rule. And what it says is that if you identify more than 3 properties and you go over 200%, then you have to close on 95% of the value that you've identified for the exchange to be valid at all. So again, you sell something, so this guy, and he did it up front, and I was the one who was chewing my nails the entire time until it was done. And he was like, it'll be fine. And it was. So he sold, this was a long time ago, and I still talk about him. So he sold something for like $400,000, some land, and he identified 8 or 9 townhouses that went way over 800,000 in total. And I said, if one of these has a title problem, if one of these sellers backs out, your exchange is going to blow up. And he's like, well, and it was fine. But the reason I bring that up in connection with the 200% rule is that I tell people when they say, well, what's the value? Is it the asking price? Is it, you know, to me, especially in this market where sometimes people pay more than the asking price to get a particular piece of property, put down what you're willing to pay for it in that, on that line where it says value. We don't show that to the sellers. They'll never know that you'd be willing to pay $100,000 more for whatever it is. But we want to be sure that we don't accidentally sneak over the 200% and blow ourselves into the 95% rule, because most people identify more than 3 because they don't know exactly which ones they're going to get. And so then, you know, they identify 5, but they plan on buying 2 or 3. And if one of those that they're buying, if they're bumping right up to that 200% rule, and if one of the ones that they're buying, they end up paying a little more, if that pushes them over in total, when you add it back up together, because the identification matters to the IRS, then then you'd have to buy all of them, basically 95% of them in order of the value, in order for the exchange to be valid at all. So
2 questions.
yeah.
Do you have to set up a new 1031 exchange every time you purchase, or is it something that you can use for like multiple years for multiple?
Oh, no. 1031 is specific to a sale of a particular piece of property.
So, but you sell one, you buy another one.
Uh-huh.
And then when you go to sell that second one that you bought, new 1031
Yeah.
exchange? Okay.
Yeah, because again, 1031 is a deferral. And so this is what happens sometimes. You know, I have a lot of customers who say, okay, well, remember me, I bought this 3 years ago, and now I want to sell, or I bought 2 of them, I want to sell one of them and buy something else. You can do that. You'll do another exchange. And if you do another exchange, you continue to defer what you've deferred the first time around and any new gain.
And then the second part of that is, I know you have 45 days to identify, 180 days to close. Is there a time frame on when you need to sell that one that you purchased?
No.
So like if you hold it for a year, have a tenant in there and then sell it?
Yeah, so there is no time frame that says this is how long you have to hold it in the rules. 1031 allows you to defer long-term capital gains. So you have to own it at least a year and a day in order for it to be long-term capital gain. Sometimes people push it around, and I'm like, if your CPA says that's fine, I'm not involving myself in that decision. But most people will say that that brings me, I guess, to the next topic. Some people buy a piece of property to ultimately move into it, right? Like they'll know they are going to retire in, like one of my customers in Oklahoma, because that's where her grandkids are, and she's going to retire in 3 years. So she did an exchange. She bought a house in Oklahoma. She's going to rent it out for 3 years, and then she's going to move in. So in those circumstances, most people say, you know, rent it for at least 2 years. Again, there's so much difference in risk tolerance amongst CPAs, right? As far as what you think is is fine and what you think is not, that we just, I'll leave that up to you and your tax advisor. Yeah.
What is the definition of investment property?
Any property that is Well, it's held for investment, so it excludes primary residences and purely second homes.
The question was, what is the difference, or what identifies as investment property?
Yeah, so rented. At least, so this happens a lot of times where you have people who are, are going to sell something. And I have so many people buying things in the Outer Banks right now, which is why my son says the prices are way too high. Mom, stop. I'll never be able to afford a house. But when you buy, seasonal rented properties, like either in a ski area or a beach area, you will want to go through at least 2 cycles of having it in the rental market. You can use it yourself for the greater of 14 days or 10% of the time that it's rented. And that does not include the time you spend cleaning something, checking on something, fixing something. So, and I say, there's not likely to be an IRS agent at every cul-de-sac asking, are you here more often than not? But you will want to be careful, because there was a case in, I think it was like 2014, where there was a family that they sold a beach house. It had been purely like the family place. And they bought another one that was purely the family place, and they set it up as an exchange, and they got audited. And their argument was, well, we bought this first one with the intent that it increase in value, which should be sufficient investment intent, and they lost. And so that sent ripples and fear through especially through, the sand bridges and the Outer Banks and the ski places. And so the IRS came out with a safe harbor when it came to that. And what it said is that it requires kind of a lot of time, but what it says was, if a property was originally a second home, if you turn it into an investment property by renting it for at least some period of time, for 2 one-year periods, and then you do your exchange, and you do the same thing with the new property, then the IRS has agreed they're not going to look at what you used to do, and they're not going to look at what you do down the road. But it's a 4-year process.
So basically, you're saying it's 2 years on the back end and on the front end.
Exactly.
So pretty standard. If most of you know about mortgages and stuff like that, 2 years is like the rule of thumb. So pretty easy to remember that.
Yeah.
That's good.
Yeah. Yes.
So if an investor buys a house to flip and sell, they can't use that property, they can use that property to get a 31 exchange to buy their own home?
No. So that's
So-
a couple of problems.
So the question was, if an investor has a home and they're going to do a 1031, can they now take that investment property and then do
Primary residence?
make it their primary?
So they cannot immediately. At the time, the intent has to be that the new property be investment property too. But the other part of the question was, if they're flipping a property, they bought an investment property, they're fixing it up to resell it, they do not qualify for 1031. First of all, they're usually short on the time period, right? Of holding it for a year and a day. But more importantly, that is deemed to be property held primarily for resale. So people who are builders, people who are developers, people who flip don't qualify for 1031, because again, the IRS says you held that primarily to resell it, therefore it's your inventory, and therefore it doesn't qualify for 1031.
I was
Yeah.
going to ask about redevelopment zones and if we should avoid purchasing in those so it doesn't get confused with inventory.
Well, not really, because what people used to do, the former owners did, doesn't matter. I had a gentleman just the other day who said, I want to buy this house, but it's these people's primary residence. And I'm like, that doesn't matter. What they did with it doesn't matter. It only matters what you're doing with it.
Yeah, like if you were to purchase like a wholesale, block,
Mhm.
In a redevelopment zone with the intentions of fixing it up and.
Yeah, then you're not going to qualify.
Right, but fixing it up, renting it for a couple of years and then do, another 1031.
I
just as
think
long as
that's
you-
perfectly fine.
Okay,
Yeah,
all right, got it.
yeah. As long as, you bought it, yes, you had to do some fixing up in order for it to
Yeah,
get
which I can
rented.
Capitalize just as long as it's within that 180 days to close. for the benefit of the tax deferment. So like, for example, say I
So
have-
you're selling something and then you're purchasing
Yes.
that.
I
As
sell
long
my
as you can
property, I
buy that
purchase
block in the
this.
180 days.
Yeah, well,
that's
and I
okay.
only spent 75% of my, my 1031 exchange. Could I use the rest of that
Yeah, that's a-
20% to capitalize to improve those properties
Mhm.
deferred?
That's another great question, but once you own the property, what the IRS says is then you're paying for labor and material, which is not acquiring like-kind property. So you want to put the money into the, sometimes what we have, like the house needs a new roof, get it done on the seller side and just pay them more. Because to them, it shouldn't make a difference because that increases their basis. And so, yeah, there you go. But that's sort of the long and short of it. We 1031 again now, since this Tax Cuts and Jobs Act in 2017 is only available for real estate, but all real estate is still deemed to be like kind, so you're not limited to buying the same type of thing. I cannot talk about my favorite exchange of all times because it was before the Tax Cuts and Jobs Act when people could do exchanges. We used to do a fair number of boats, like fishing vessels and cranes and barges and stuff. And for that, it was the depreciation recapture that, helped people. That went away. So it's just real estate now. But one of the other things, I never did livestock. But they are in those categories, it was property held for investment, right? And so the categories were tighter. So it wasn't everything wasn't like kind. So if you sold a cow, you couldn't buy a steer and stuff like that. But my favorite exchange was a 1964 Aston Martin Volante that was sold for $1.4 million and exchanged for 2 Ferraris from the 70s. And I miss that desperately. But I mean, artwork and, stuff like that, but that's all gone. So, but real estate is still there, and real estate, I don't think is going to go anywhere. With respect to 1031, it really helps people to be in the kind of property that works best for them, yeah.
If you have a property that's been a rental for many years, but the last couple has not been actively rented, would that still qualify or not?
As long as you haven't moved into it, I guess. Yeah, I think
If it's just
so.
been- If it's just been.
Yeah.
rented,
Yeah, I think that's probably perfectly fine. Sometimes, I mean, stuff happens, and that's the other question I get on the other end is, what if I buy this property in the middle of nowhere and then nobody is willing to rent it? Well, as long as you have it in the rental program and I mean, what are you supposed to do? But it does allow you to, I'm sorry, yeah.
When structuring a transaction, you've got a big 1031 that you're flowing into others with trusts and individuals. If mom owns the major property, should it be structured in a LLC trust to then mom, daughter, and husband buying the additional properties?
So in 1031, the taxpayer selling has to be the same as the taxpayer buying. And I mentioned exclusions from 1031 being primary residences and purely second homes. I should have mentioned the other exclusion, which is interests in entities that own real estate. So if you own 30% of an LLC with your sisters, you can't do an exchange with your 30% interest. And so if the taxpayer selling has to be the same as the taxpayer buying. So if mom owns a piece of property and she's going to buy some investment real estate and she wants to put it in a single member disregarded LLC that rolls up on her personal return, that's fine. But she can't buy it in an LLC with her kids and other people.
Be beneficial if mom owns it to then have the other parties prior to selling be part of ownership of the selling.
Yeah.
So she can't individually sell and then become part of a grouping LLC to then.
Again, you still wouldn't be able to do that. So if mom and her 3 daughters form an LLC and they put the property in it, it used to be mom's, but they put it in there, and then that LLC does an exchange and buys something else, that's fine. Yeah.
While we're on the subject of family, the holding,
while we're on the subject of family, while you're holding it before you sell it for the year and a day, does it matter who's technically renting it? Can it be family? Does it need
I
to
think that's
be?
fine,
Okay.
yeah, as long as you, again, as long as you treat it as investment real estate on your tax return, I think it's fine, yeah.
So, going into the LLC, back to that piece, can it be in different LLCs so long as the sole proprietor is the same for each? if I-
As long as the, so, a lot of people put each rental property
said
in a
so that-
separate
yeah,
LLC.
exactly.
But if each of those LLCs is a disregarded entity for tax purposes, a pass-through entity, and the taxpayer is Fred.
Right, exactly, yeah.
Then
Fred
it's,
owns all of the
then
LLC.
Fred would be the exchange, Fred would be the taxpayer doing the exchange, holding title through ABC, LLC, BC, blah, blah, blah.
Right.
And if he's selling them all at the same time to the same people, he can just do one exchange, and then he can buy the new property either individually or in one of those LLCs or form a new one. But again, as long as it's passed through, as long as you have the same taxpayer. I know,
Oh, no.
yeah, one more.
Tricky question for you.
Okay.
For those 1031 investment funds,
Mhm.
if you decide to take these funds that came in with your capital gain and purchase property with those funds, take it out of that investment fund and then pull it out.
Yeah, so.
And when you pull it out, does that become a taxable event, or can you, go ahead and purchase additional rental properties and
So,
keep that deferring your taxes?
I think I understand what you're saying. So most of the, I think the funds that you're talking about would be like a DST, a Delaware Statutory Trust.
I was thinking about
investment.
Hines, Hines.
I don't
It's
know.
a 1031, like.
Oh,
investment
yeah,
fund.
but it's a DST, but most of those companies, so people will do an exchange, people who are tired of their tenants or whatever, and they're tired of managing things. They sell their investment real estate and they buy into one of these, it's either a TIC, a tenant in common arrangement, or a DST, a Delaware Statutory Trust. And I just heard that name the other day for the first time. So there's a lot of these providers, and they'll buy something big and they'll sell you a little chunk of it. For most people, that is not liquid. So if you're going into one of those, you're generally not able to go out on your own, because you'd have to find somebody who wants to buy your 0.754% of whatever it is.
It's a holding requirement of 2 years. So if you
So-
put money in the fund, they want it for 2 years. So I'm just thinking at the end of those 2 years,
Yeah,
if you
I
want to take that and buy 2 more homes.
you
or
could do
whatever,
that if they allow you to get out. So most of the time what happens is DST investors, we have one of our founding directors at the bank who's literally on his third iteration of one of those, where he sold his commercial property, bought into a DST, then 5 years later, the DST provider sold the big thing, and they did another exchange into another one. But I have not heard of any of them that offer clearly that after 2 years, you can do whatever the heck you want and you can sell your share and buy something else.
They're suggesting the conversion into like a money market to protect the investment part of it. But
Yeah,
it's
but
just- it's so
then you
super
wouldn't have the
confusing because
deferral
You
anymore.
can't defer it.
Yeah.
Once that time comes and
Yeah.
you take that money out, it
Yeah.
becomes taxable.
Yeah, yeah. I have
So-
to find out more about that
It's super
particular company
confusing.
because we work with a lot of them. We work with Capital Square out of Richmond, and they, the big example I have here is I did an exchange for a seller who sold a big apartment complex in Virginia Beach called Salt Bay Meadows, or something like that. It's been a few years. Salt Meadow Bay, that's the one. I knew it was something like that. And so they did so my customer did an exchange into something else, but the people who bought it were a DST provider. And then I had like 7 people buy into it, little chunks. And one of my friends, every time I drive by it, I say, I own 0.145% of this. So I don't know enough about that company, but it's interesting because that name has come up just the other day. And I had to tell the people that, when somebody asks me about DSTs, which are a nice passive investment. Our director says Not only do I get my money every month, I don't have to do anything and think about anything, but every time they sell, I make money and I just do it again. But again, the flip side is that you don't have any say and you don't, generally speaking with those, you can't get out until they sell again. Yeah.
What happens if you do not meet that 45 and 180 day?
If you
Is there a
don't,
penalty? Is it just
No.
you
just pay the
capital gains?
taxes. So that's the last thing I want to say is that you don't you don't control the funds during the exchange. So during that 45 days, unless you want to buy something immediately, which happens right now a lot, like next week, I'll buy my replacement property. You can't control the money, but if you don't make an identification in the 45 days, then we would return your funds less our fee, which is $950 for a 1-for-1 exchange with an additional $100 coming out if you buy more than one replacement property. But if you don't identify anything, we'll just return your funds on day 46. But if you've identified something, that was the second really bad thing that I didn't get to when I said the bad thing is that you're stuck with the properties you've identified. The really bad thing is if after the 45 days they all fall through, then not only do you not get to substitute something else, but your funds are going to be tied up till the 180th day, because we can't allow one customer to control their funds without risking all the other ones. And we've done about 150 of them this year so far. So
Wow.
it's a lot.
Wow.
Yeah.
Changes coming with the time, right?
No. The only time I get the question about the extensions all the time, and the only kind of extensions that you get are the ones you don't want because they're disasters. So for example, all of North Carolina last year was put in a federally declared disaster area because of the floods. And so everybody now has until May 1st to do that happened in that time frame instead of the 180 days. But, it's not usually something you want. So it's hurricanes, wildfires, that kind of thing. So that's specific to the place. There was one more question.
Yeah, is there any rules against refinancing before or after the exchange?
So what you don't want to do is make it look like it's not really an exchange, that you're cashing out. So you want to wait a little while, and you would want to talk to your tax person about that.
What states do you operate in?
All of them.
All 50?
Yeah.
Wow.
Yeah, and it's the 50 states, DC, the US Virgin Islands, and Guam. So Puerto Rico does not work, but I've done 2 exchanges in the last few weeks in Guam. Go figure. There's like 27,000 hours difference or whatever. It's like tomorrow, next week or something, but yeah. Yeah.
Is it possible to do a partial investment? You buy something and the balance move it to DST? Is that possible?
Yeah. So I have some people who just use the DST kind of as a backup, in case something happens. But you can definitely buy a
Lower value and put the balance.
Yeah, exactly. So DST providers sometimes have they have a certain requirement. Most of them, it's like 100,000. Some of it's more, but yeah, you can. Thank you, buddy.
Yes.
Appreciate it so much. Thanks,
Wow,
guys.
That was awesome. Thank you so much.
Thank you.
I want to give a huge thank you to Coastal Town Realty for hosting us today. Thank
Yes.
you, Coastal Town and Thomasina. And yeah, thank you all. And
And Cregan will send you the outline
yes.
that I share with people.
Yep. And if you've signed up on Eventbrite, you're going to be getting it there too. So thank you so much, everyone, for coming today. Yeah, please put your emails in the chat if you need it and you did not sign in. Thank you so much for coming. So I will say one more time, if you have any clients that are looking to do a 1031 exchange, obviously we can do the financing for that. So please reach out to us, myself or Courtney. Please grab one of my business cards before you leave. You're welcome to any of the little gear, the stuff over there from AFN. And then the bottom on the left, if you scan that one, that is all my social media stuff. If you don't already follow me on social media, I encourage you to follow me on social media because I do a lot of talking head videos that kind of
So if
can
I-
educate you and your clients. If you see something you like, please like, comment, and share so that your clientele base can see this information. Okay? Thank you so much.
I appreciate it.